You're listening to a podcast of Master Your Finances with me, Kurt Baker, a certified financial planner professional. Sunday mornings at 9 a.m. on 1077thebronx.com.
Another day, another dollar, and our certified financial planner professional, Kurt Baker, will give you the tips you need to turn that single into a sea of green with Master Your Finances. Whether you have enough to get by or too much in your pockets, Kurt Baker and his weekly guests are here to show you how to manage it all. Master Your Finances is underwritten by Certified Wealth Management and Investment LLC. Now listen up, because it's time to get a hold of those money matters and master your finances.
Good morning and welcome back to another edition of Master Your Finances, presented by Certified Wealth Management Investment. I am Kurt Baker, a certified financial planner professional located in Princeton, New Jersey. I can be reached through our website, which is www.cwmi.us, or you can call me directly at 609-716-4700. This week, we're very pleased to have back with us again Patrick Ryan, who is the president and chief executive officer and member of the board of directors of First Bank. Patrick is responsible for the strategic direction and overall performance of the company. As president and CEO, Mr. Ryan has led a successful $23 million initial public offering for First Bank in 2008. Today, the bank has over $2.01 billion in assets as of the end of 2019. First Bank has been named as one of the fastest growing companies in the state, receiving the NJ Biz Fast 50 award 4 straight years from 2016 to 19. Prior to First Bank, Mr. Ryan worked as an investment banker at Goldman Sachs, a management consultant at Bain & Company, where he worked as a private equity consultant. After earning his MBA at Dartmouth, Mr. Ryan is hired as a consultant for the management consulting firm of Bain & Company in Boston, where he worked on private equity consulting. Mr. Ryan has served on the board of several nonprofit organizations, including the Trenton Area YMCA, Hamilton Partnership, Friendly Sons and Daughters of St. Patrick, State Theater, and RWJ Hamilton Foundation. And as you know, Pat, I appreciate you coming back, and this is really important right now with what's going on out there. I think for everybody, we're affected in one way, shape, or form. I know we have a little small profit that we run, and I guess we've got several programs through this CARES Act, and I think there's the SBA kind of direct thing, but there's also this PPP program, right? The Payroll Protection Program that's out there as well, and you're kind of like right in the middle of it because you're a mid-sized community bank, and we're really relying pretty heavily on you guys to help us out a little bit. Do you want to tell us a little bit about the programs that are out there and what you're seeing as far as how the rollout's going? And I guess we had an initial funding, then a second round of funding, right?
Yeah, exactly. But no, you're right, Kurt. It's been very, very busy. And, the Paycheck Protection Program is a component of the $2 trillion CARES Act that was passed by Congress a few weeks ago. This was the piece of it related specifically to small businesses. And it was the piece to try to get, money quickly to small businesses to help them meet some of their immediate needs in terms of retaining their staff, making their payroll, as well as paying some other expenses like rent, utilities, and loan payments. The entire program initially was $350 billion, which sounds like a lot of money, although somehow within a matter of 10 days to 2 weeks, the initial 350 had been fully allocated. They did subsequently approve another 310 billion, and that's kind of the round 2 that all of us are working through now. For folks that aren't familiar with the program, a couple of things I think it's worth highlighting. It is administered by the SBA, but it's not a typical SBA loan. I've heard the moniker perhaps somewhat derisively that this is not a loan as much as it's a GROAN, which is a grant and a loan. And apparently the GROAN was a reference to the fact that early on the process wasn't running as smoothly as some would have liked. But it is a forgivable loan, which is why some people are thinking of it as a grant, although it's important that folks understand which types of expenses are forgivable, so that when they go back to the SBA to have some or all of the loan forgiven, they want to make sure that the the way the funds have been spent line up with the forgivable expenses in the program. But it's again primarily for small businesses, defined as businesses under 500 employees. And when you're dealing with a normal SBA loan, there's lots of industries, including nonprofits, that are not typically eligible for SBA loans, and the pool of eligible companies was really significantly expanded as part of this Paycheck Protection Program, or PPP. And so at this point, pretty much any organization that's got under 500 employees, with a couple of exceptions, could be eligible for the money. And basically, the way the program works is you take a look at your average monthly payroll, either for 2019 or over the last 12 months. You multiply that average monthly amount by 2.5 times, and that gives you the loan amount that you can submit for. And then ultimately, those funds can be used to make payroll going forward. And the way it works is you work either with your existing bank or with a bank that is doing these PPP loans. You got to fill out the application. You work with the bank to make sure the application looks correct. The bank then works to get that application submitted to the SBA, at which point, hopefully, the application is approved. I believe the vast majority of these applications are approved. And then you work with the bank to get the loan documented and funded. I will tell you that there are requirements that loans get funded within 10 days of receiving SBA approval. I'm proud to report that at First Bank, not only have we done a lot of these PPP loans, we've done over 600 for north of 150 million worth in loans, and we've been able to get all of them submitted and approved, and we've been able to get all of them funded so far within the 10-day requirement. And what you found, and you mentioned this, Kurt, is that some of the larger banks and some of the fintechs tried to take a technology-driven approach, and for whatever reason, that didn't work very well with the SBA systems. And kind of the traditional community bank model, working directly with an individual, doing it the quote-unquote old-fashioned way, seemed to work much better as this process has been rolled out. So covered a lot there. Why don't I pause and see if you have any questions on any of that?
Well, yeah, I know that one of the things that keeps coming up is, I guess you got hit on a couple of these things. One of the things that comes up a lot is the PPP. I guess they're restricting it. 75% is my understanding has to be used towards payroll, and then 25% for other expenses like lease payments, mortgage payments, things like that. I mean, what are you finding as far as that goes? I mean, let's say, if I have a payroll of, I don't know, let's say my number ends up being $100,000 for this 2.5 times the monthly. I mean, am I getting the $100,000 for the payroll, and then I'm deducting the 25% for my mortgage portion? I mean, see, if my payroll is $100,000, I'm only going to be getting 75% of it, correct? If I'm allowed to use it for mortgage and lease. I mean, how does that math work out when you actually apply?
The short answer is you have an 8-week window of expenses that can be paid once you receive the funds. And so if you think about it, if you take your monthly payroll and say that's sort of a 4-week period, 4 weeks being a rough estimate of a month, and in order to figure out the amount you could borrow, you took 2.5 times that 4-week amount, yet you only have 8 weeks to pay the amount. Basically, what they built in was the buffer that you need in order to be able to cover some of these other expenses. So that $100,000 loan amount, if you kept all your employees at your same salary or rate over an 8-week period, you wouldn't be able to spend $100,000 on your payroll because it was a 2.5 times calculation. So it's kind of built into that in the way they figure out the loan amount.
Oh, that's where the 2.5 comes in, I guess, and then the 8 weeks. And I guess another thing I've heard of is that since the program keeps sliding, I heard it's June 30th deadline. Is that still exist? I mean, this 8 week, is that kind of a sliding 8 weeks based on when you're approved? Or what was that June 30th number, that date that came up at one point that people were very concerned about?
The June 30th date, I believe, is the date where you have to get your application in and your loan closed and funded. And then the 8-week period starts the minute you get the funds. So if you got the funds yesterday, you got 8 weeks from yesterday. If you get the funds on June 21st, you got 8 weeks from June 21st.
Okay, so you don't have to be overly concerned about whether you were approved a couple weeks ago or a couple weeks from now. As long as you get in under the June 30th deadline, you should be in good shape, it sounds like.
Yeah, the only potential challenge there is the fear that even this round 2 will run out of money. And so far, that does not appear to be as big of a risk as some people thought. I mean, in round 1 and again in round 2, there were lots of people saying the money's going to run out in 2 days. You better get your application in now or you're going to run out of funds. And, the first round lasted 2 weeks. I think the last I saw from the SBA, 50 billion of the 310 so far has been allocated. So, based on that pace, you would expect that, this pool should last for another few weeks at least. But the concern is if you don't get in before round 2 runs out, you might still fit within the June 30 timeframe. But if there's no more money allocated, then you may not get a loan.
Right. Excellent points. I definitely have some more questions, but we're coming up on a break here. You're listening to Master Your Finances. We'll be right back. SBA loan and things like that. And then those were kind of easy, right? Because they were already in the system, so to speak. Did that really make any... And banks were starting with the larger companies and working their way down is one thing I heard. Is that true or not?
Well, I know it wasn't true at First Bank.
Right.
But I also couldn't speak to what other banks are doing, but I don't suspect that that's true. What I think is the larger companies, which are the ones that, based on the formula, will qualify for the larger loan amount.
Right.
They have a more robust finance and accounting department. They have more people. And so they were the ones who got their applications in right away because they had the manpower to figure it out and submit it. And, the mom and pop who's trying to run his business day to day, it just took them a lot longer to get their application put together.
Right.
I think it's one of those things where, politicians want to score political points by claiming that there was some, devious prioritization. I just don't think that's the reality.
I didn't really read it that way. I think it was just the volume. I mean, my impression was, I kind of understand what you guys are dealing with. It's just a volume. It's just coming in. And I agree with you. I think, if I have an accountant that's full time and I say, hey, I call them up and say, please send my application, it'll be in a couple of hours. I mean, they'll just do it. Yeah. Right. Yeah. And you're right. If I'm running an organization, I'm like, well, I got stuff I got to do. I'll do it like tomorrow or Thursday or whatever, and whenever I can get to it.
But, and I think, there have been some, high profile politicians that are claiming that the banks are prioritizing the larger loans because the fees would be higher. But, again, I think everybody was working first come, first serve. I just think the bigger companies got the applications. But the other thing, at the end of the day, because there's a sliding scale on the fee, if you did a loan north of $2 million, you got a 1% processing fee. If you did 10 $200,000 loans, you got a 5% processing fee. So it's more work. But the economics of the smaller loans might actually be better. I don't know. We haven't done the analysis, but you know what I mean?
Right. No, I love to bring, because that has been an issue. If you don't mind me like touching on it a little bit, because I think people talk about it. I'd rather have the facts out there if you don't mind.
No, I like to.
Let me know you're ready, bud. You ready?
Oh yeah, I'm ready.
Okay. Yeah. All right. Whenever you're ready.
Okay, I count you down. So in 3, 2, 1.
Welcome back. You're listening to Master Your Finance. I'm Kurt Baker here with Pat Ryan, the president and CEO of First Bank. And we've been talking about this, the PPP program, which has now gone through 2 rounds of funding. We used the first, I believe it was $350 billion. We used that up pretty quickly in about 10 to 14 days. Now we're working on round 2. There's about $310 billion. And it sounds like we hit some of the demand because from your perspective, you were saying doesn't seem to be going out the door quite as quickly, which I guess is a good sign, but that doesn't mean we may not run out. So there's this interesting phenomenon going on. One of the things that we've been hearing about, and I'd like you to kind of clear this up a little bit, is that hey, I'm a large company, so the banks are going to fund me my $10 million and, and kind of ignore the poor guy that needs $50 or $100,000. I mean, what are your thoughts about that? I know as a small business owner, if I'm running around trying to run a business, I just might not get to it, right? Whereas if I'm a big company, I probably have a staff that can handle this for me. So, I mean, what are you seeing as a community bank, kind of in that midsection where you see both ends of this a little bit?
Yeah, no, it's a great question. And I think, people will look at the data and then try to interpret it in a way that supports whatever pre-conclusions they've already drawn. But, our experience was that, 95% of the loans that we did were sub 2 million, right? And 2 million was kind of the cutoff at the SBA to be deemed a large loan under this program. So the vast majority of what we saw were smaller loans, and those were the loans we did. But what we did see was the larger companies, who are the ones that qualify for the larger loans because they have a bigger payroll. So you're multiplying 2.5 times the larger payroll. Those are the companies that have those finance departments you mentioned. So those are the ones that had their applications in the minute that the door was opened. And so a lot of them probably got processed sooner just because the applications were ready faster, because they had the manpower to do the work that was needed to get the application completed. So my guess is some of the larger loans did get funded first, but I also suspect that was just a function of them getting submitted faster because they had the manpower to do it.
And did it really matter? Because some people were talking about how it might make a difference if you already had an SBA loan, if you already had a relationship with SBA. But this is kind of different, right? I mean, it's my understanding it might be going through SBA, but it's not really an SBA loan. So what are your thoughts about, was it easier or harder if you already had an SBA loan of some kind of relationship like that?
Yeah, I don't know that it was easier or harder if you already had an SBA loan. I can tell you a couple things. If your bank was an SBA lender, that was a big benefit because those banks were ready day one because they have experience working with the SBA. And you're 100% right. This loan is very, very different than a typical SBA loan, but the process and the infrastructure and the communication mechanisms are similar. And so already being registered gave that bank an advantage. I will tell you, we were in a little bit of a gray area in that we do a couple of SBA loans every year, but we're not a high volume SBA bank. And so we didn't have a huge SBA department dedicated to handle this huge volume. So to give you an example, we probably do 5 or 6 SBA loans a year, standard SBA loans in a typical year. And as I mentioned earlier, we've already done over 600 of these PPP loans. And so, the obvious question is, well, how the heck did you do that? And the answer is we had to reallocate resources, and we reallocated a lot of resources. But the fact that we were already SBA approved and registered to communicate with the SBA made a big difference. So if you were at a bank that wasn't SBA approved, that probably created a challenge for you. And, quite honestly, there aren't that many high volume SBA banks across the country. And so realistically, the odds are that your bank either didn't do SBA, or if they did SBA, they weren't a high volume SBA bank. A lot of the big national banks are SBA banks, but they became so inundated with volume that they had a hard time getting through it. A lot of them tried to implement technology-driven solutions, again, which didn't quite work out, I think, the way they would have liked. And so a lot of the business is getting processed through the community banks. And quite honestly, I think it's a good reminder of the community bank value proposition, which is having that relationship, having somebody you could call, because the frustration came not only because you didn't get your loan right away, but you also couldn't get an answer. And so the nice part of dealing with a community bank is you had a personal banker you could call. They could tell you, here's where you are in the process. Here's the expected timeframes. And like I said, we got 95% of the first round loans that came in approved. And within 3 days, all of the loans that didn't get approved the first time and several hundred more that came in between got approved within 3 days. And I think that's because we were able to, kind of manage the process a little bit better.
So you mentioned that, I guess, obviously we want to get it approved. What are some of the reasons that a company might not be approved for this? Because it's supposed to be pretty streamlined, correct? For the most part.
It's not a traditional credit underwriting. It's more an eligibility review. But, we spent a lot of time reviewing applications to make sure the calculations were done right, because there are certain rules about what payroll expenses can and can't be included in the calculation. And so, we worked with our borrowers to make sure they were doing the calculation right, because they don't want to be in a position where they come back and get audited and the federal government says, hey, you did this wrong, we got a problem. We wanted to try to avoid as much of that up front as we could. But it really came down to making sure the calculation was right, and then just making sure that the eligibility worked. Were you in an industry that qualified? Did you fit with under the 500 employee thing? And so there were a handful of eligibility criteria that need to be checked. But as long as all of those fit within the box, once you got it submitted to SBA, you got an approval back very quickly.
Yeah, one of the things that comes up is we're a small nonprofit, and some of our stuff is seasonal, and we actually have an increasing payroll, fortunately, because we've been doing a little bit better. So how do they do like that calculation? If I'm making most of my funds, let's say this quarter we're in when this all hit, and I'm not really showing that yet. You know what I mean? So
for seasonal businesses, they did build in a mechanism. I don't know how good of a mechanism, but it was a way to look at and say, okay, I'm a seasonal business. Here's my payroll from February to May, for example, and use that as your basis to do the calculation rather than a strict average over a 12-month period. But you really had to make sure you follow the rules there too. So if you're a business that you think qualifies as a seasonal business, it's important that you talk to an advisor, an accountant, somebody who can make sure that you're following those rules correctly, because there is a way to adjust for that, Kurt. But again, you got to make sure you follow those formulas.
Okay, so we've all heard some stories about some very large entities getting funding, like some large franchises and things like that. A lot of them have been returning the funds. I mean, this was supposed to be restricted to 500 employees, right? Is it because, if I'm a franchise, I'm going to open up each franchise with its own like tax ID number, even though it's really a major company? How did all that work? And because it didn't sound right the way it was flowing out the door.
Yeah, I mean, listen, you got some revisionist history going on. If you remember when the act was passed, there was a rush to get the money out the door as fast as possible. And as a result, they couldn't build in too many restrictions to the program because it was just going to bog it down too much and create a slowdown in getting the money out. So I think when they originally designed it, they knew it wasn't going to be 100% efficient. They knew it wasn't just going to be going to those most desperate and those most in need. But I think what they said at the time was, hey, this problem's so big, we got to address it quickly, and we're just going to have to live with some inefficiencies. And when I say inefficiencies, I mean money going to companies that maybe turns out didn't need it. So that's, I would argue, an inefficiency, because that creates additional deficits and debt that need to be paid back. And in essence, it was to give money to companies that ultimately didn't need it. But the only real restriction was you had to certify that your business was at risk because of COVID-19. And so that's a pretty vague standard. And I think a lot of folks sat there and said, well, geez, you know what? I may not be doing layoffs today, but, I'm also hearing stories about millions and millions of deaths across the country, and how bad could this thing get? And what am I going to need to do if it gets really bad? And so I think a lot of folks said, geez, I'm not sure, but just in case, I'm going to apply. And I think a lot of folks said, hey, listen, if the rules are the rules and I fit within the criteria, why can't I apply? And so I think you ended up getting a lot of applicants. And then in hindsight, people said, well, geez, we really didn't mean it for you, or we didn't really mean it for you. But, it's all after the fact, changing the rules, which, again, isn't atypical for the government. And now I think we're trying to wring out some of the inefficiencies by playing a bit of a blame game, which, I mean, listen, in a perfect world, folks would 100% do the right thing all the time. But we also live in a world where people say, hey, if these are the rules, and as long as I'm following the rules, why can't I get it? There's a lot of that right now where hindsight might show these people didn't need the money, but at the same time, they weren't sure. They didn't know, and they qualified. So why shouldn't they apply? So I think it's unfortunate in situations like this. You're always going to have, I think there's basically the money is going to go into three categories. It's going to be money that was well spent to help the businesses that really needed it. It was going to be money that was borderline inefficient because it went to businesses that qualified that maybe didn't need it. And I think there's going to be a third category of just outright abuse and fraud, which is a whole nother issue. But I think what you're seeing right now is there's an attack on this middle category saying, hey, we're not sure you really needed this. Why did you go take it? And some people are saying, okay, I'll give it back. And others aren't. And it's a gray area.
Okay. No, I appreciate that. We're coming up on a break. You've been listening to Master Your Finances, and we'll be right back. Welcome back. You're listening to Master Your Finances. I'm Kurt Baker here with Pat Ryan, the president and CEO of First Bank. And we've been talking about the PPP loan and the rollout of it and how you as a community bank really did a great job of kind of using that customer relationship, whereas the tech really kind of failed everybody, right? And the old-fashioned way of actually talking to the business owner and helping them to structure the loan properly, making sure the calculations are correct. As you were mentioning, some of the items in the payroll may or may not qualify, getting that 2.5 times the monthly in there correctly, and then funding the payroll for 8 weeks. And I guess that extra half month is really designed to help you with other expenses like leases and mortgage payments and things like that, to hopefully get people over the hump. And as you mentioned, I guess a lot of entities. I think one thing we should mention, some of the other entities were actually added, right? I guess some of the non-bank things like payroll companies were added at the second round. Is that correct? And they bolstered the community bank access too, correct? Is my understanding?
Yeah, they changed it around a little bit the second time in that they did allocate buckets or pools of the loan to be used by banks of certain sizes. So I think there was a pool for banks under 10 billion in assets. There was another pool for banks 10 to 50 billion in assets. And then everything else, I guess, in theory, was for the really big banks. But what's interesting is you look at the data on the volume of PPP loans that have been processed to date relative to the overall market share in the country, the community banks are processing a much higher percentage of the PPP loans than what you might expect if everything was just lining up based on current market share of assets in the system in the U.S. So, I think part of it is the community banks didn't get overly hung up on a technological solution. They, again, tried to work it the old-fashioned way and reallocate resources and have people involved with submitting applications instead of just blasting it through a portal. And I think that's one of the reasons why even in this round two, there's still a lot of money left, because I think the fintechs, a lot of them, they're not traditionally direct lenders, but I think they were able to get approval from the SBA to be PPP lenders. And so I know a lot of them were looking to submit applications using technological resources. And I think, unfortunately, it looks like so far there just hasn't been a good way to sync up the technology to do mass transmittal of applications. And so we're all living in a world where they're getting done one at a time right now.
Well, I think you're proving out the value of having somebody sitting in front of you actually doing the business with you and knowing who you are and actually making sure it's done correctly. And I mean, sometimes we get a little too tech heavy. Taking data and doing it, quote, the old-fashioned way does have a lot of value, especially when you're talking about things that have a lot of moving parts where you really have to keep up with what's going on. So it sounds like the community banks have really stepped up and done a great job. And I think you mentioned this, but even if I don't have a relationship with a community bank, I can still come on in and you can help us out, right? If I'm
absolutely,
whoever it is, right? Doesn't matter.
Yeah, we found this has been a great opportunity to get introduced to small and medium-sized business owners and operators who maybe ended up at a larger bank, not not necessarily on purpose. Maybe it was through acquisitions over the years and other things. And switching banks is hard. So unless there's a problem, sometimes you just stick with the status quo. But I think folks are realizing now there is real value in having a personal relationship with a banker, and I think it's causing a lot of folks to reevaluate how they want to handle their banking relationships.
Yeah, I agree. I think everybody should have a relationship with at least one community bank for sure. I want to touch on this just for a moment. I know you're not directly involved in this, but I know it's another program that's out there we've heard a lot about, initially at least, the expanded to the EIDL, an emergency grant, the SBA loan, that other one that I think was more or less direct, where you get that $10,000 within 3 days. And I know our nonprofit put in an application on April 2nd, and I finally followed up about a week and a half ago, and it's in there, but they were like, whatever, you're gonna hear back from us at some point. So you don't necessarily get that 10,000 in a couple of days. What is your awareness of that, and how does that fit with the PPP? Any thoughts on that?
Yeah, I mean, I would overly simplify it, Kurt, and I would tell you that the PPP basically came out to fix the EIDL, in the sense that that program was designed where the SBA was going to be lending the money directly. And I have no idea how that was ever going to work, right? I mean, right now with the PPP, the banks are funding the loans. The SBA is guaranteeing the loan, so it reduces the risk for the banks. But at the end of the day, the banks have the money and can get it into the accounts of the borrowers. I don't know how the SBA was going to get all this money out the door. A, I don't know how much money the SBA has sitting around. And B, the logistics of it were, I think, too much to overcome. And I think that's why when they moved to this PPP program, one of the problems they wanted to fix was, let's work through the banks, because the banks have the money to get out on the street. And I think most folks just kind of shifted gears once the PPP came out and kind of moved away from the EIDL. And I did hear that if you get one of those loans and you get a PPP loan, you got to use the proceeds from the PPP to pay back the other one. So I think for most folks, the focus should be on the PPP. And then I guess at some point, if the funds in the PPP run out and they don't replenish it, then maybe the other program could still be an option. I don't know.
Okay, I think that's great advice. Well, I know you're on the lending side of this whole thing, but you're also a business, and so you want to tell us a little bit about how you initially and have been responding to the fact that your business is being affected by this as well. I'm assuming, correct? So, what have you guys done as far as making adjustments with what's happening out there right now as a business?
Yeah, I mean, it's crazy. It's been a lot of adjusting. I think our folks are as busy or more busy than we've ever been, although in some cases not always doing the type of work that we might normally be doing. Before the PPP cranked up, we were spending a lot of time fielding calls, questions, concerns from customers about loan payment deferrals and how do they make sure that they can get some breathing room while their cash flow is drying up. And so we spent a lot of time working with and talking to customers and helping them. And then, we had to quickly shift gears on this SBA PPP. As I mentioned, we've done huge volume. We have a very small, kind of dedicated SBA team. And so we had to turn all of our commercial lending relationship managers into knowledgeable SBA PPP lenders in a very short period of time. And then we had to reallocate internal resources to help get these loan applications submitted and processed through the SBA. So we've had a group of about a dozen people who've been pulled off of their normal day-to-day assignments to help us, get the application submitted into the system. And then in round one, a bunch of those folks, we ended up having to move over to another area to help get the loans documented, closed, and funded. And then after that was done, they went back for round two of the PPP SBA approval process. And now that we've gotten through the backlog there, I think they'll probably be moving back over on the funding side. So a lot of people moving around, but it's been really encouraging the way people have stepped up, taken on new responsibility, taken on new challenges. And I think it's been nice for folks to feel like they're really playing a meaningful role in helping the community get through this crisis. So.
You briefly touched on another aspect, which is not directly related to PPP, but definitely to the whole COVID pandemic. These loan deferrals, I know, people are struggling a little bit, and so I guess one of the first things that I would think of is if I was in that situation, like, okay, if I do a loan deferral, does that mean I'm not going to be able to get a loan? I mean, deferring loans is not generally a good thing as far as your credit goes, but this is a whole different situation. I mean, are there any thoughts about what's going to happen from a business owner or an individual who might have a mortgage or a loan payment, how that's going to affect them moving forward? And on the other side of it, I mean, there's people that are supposed to be receiving revenue from this, right? If I'm a holder of this on the other end and I'm expecting income from my mortgage-backed security or my loan payments, how is all that kind of washing? How's that all coming together?
Yeah.
There's a lot involved there.
Yeah,
from my perspective.
There's a lot of pieces to it. I would tell you that one thing that has been really good is the way the regulatory agencies have stepped up to provide guidance to the banks that basically made it very clear that they were not going to come in and punish the banks for working with their borrowers during this time. And so, one of the challenges we have as bankers is we're normally cut in the middle. We're trying to do the right thing by our customers, but if we're too lenient with our customers, then the regulators come in and want to criticize our loans and put us in the penalty box, which obviously we don't want to get in. So they basically said, hey, what we need you to do right now as banks is help these customers, and we're not going to criticize you for giving them short-term payment deferrals. And the guidance went beyond that to say, we won't consider these loans to be non-accrual loans, even though they're not currently paying. So that was important. And they also said that if people are not paying on these loans, they should not be reported to the credit agencies as being behind on the loans. And so you almost created this, frozen moment in time for 3 to 6 months where it shouldn't have a negative impact on the business or the credit score, assuming that when we get through the deferral period that they can pick back up where they left off and make those payments. And I think it's also important that people realize these are deferrals, they're not forgiveness. So if you have a mortgage and you defer payment on it for a few months, ultimately that amount gets tacked onto the back end so that when you refinance or pay it off, it ultimately needs to be paid. So.
Now, is the loan term? Now, is the payment going up, or are they going to push? Because obviously, if I'm accruing interest for 6 months, my balance is going to go up, right? So, is my payment going to be adjusted to cover that new balance? Yeah.
Every bank has flexibility in how they want to handle those, those incremental payments that aren't getting made. But I think what most folks are doing is just applying it to the back end as a additional amount owed at maturity, right? So most loans have some amount of balloon at the maturity period. And so, if you had a 5-year loan, you're 3 years in, you miss a few months payments, you take those, you tack it on the back end. But ultimately, the borrower presumably was planning on refinancing that loan at maturity anyways, given the significant balloon payment. So I think it just gets moved back.
Okay, it sounds good. That sounds like a great plan. You're listening to Master Your Finances. We're going to be right back. Welcome back. You're listening to Master Your Finances. I'm Kurt Baker with Pat Ryan, the president and CEO of First Bank, and we've been kind of going through the PPP program. And I guess that's really kind of an improvement of the EIDL loan that was initially rolled out. So from what, Pat, you were saying, is it probably better at this point, if you need any funding, to essentially go to a community local bank and apply for the PPP loan, because you guys can get a process, you can get it out the door, you can make sure it's correct, and much more likely to get funding quickly than these others. As I mentioned, I applied for that other one back on April 2nd. I haven't even gotten a response. So that's a much, I don't know if there's any funding for it anymore. So the PPP is really kind of the way to go. And you also talked about how if somebody really needs to defer their loan payments, then that's kind of okay, at least for the next 3 to 6 months. And most likely that'll get added as kind of a balloon payment at the end, when most likely most people were probably going to refinance anyway at some point. So it's not going to have a huge impact on cash flow once things kind of get started back up again. Hopefully that'll be sooner rather than later. I think you guys have done an amazing job, especially, not just First Bank, but as, the community banks. I keep hearing great stories about how, you kind of have this federal entity that's supplying the money, but it's so massive. You really need the local community banks who really understand their communities and have people who are willing to essentially change jobs. Like you had 12 employees literally learned brand new jobs so that they could get this money out the door and help people. So I guess you guys done an amazing job in a crisis. You kind of proved that out. So why, I think you're really proving why community banks are so important. So you want to kind of reiterate the importance of having community banks and why they're critical to our overall economic health?
Yeah, I mean, listen, I think some of it you just hit on, which is, the local component to it, where, sometimes you just need to have somebody you can talk to. And normally I would say sit down with, but right now you can't really do that. But, even if it's on the phone, I mean, the bottom line is people have questions, they need help, they need guidance, they need support. And, it's the old fashioned banking model where, if you think about, small town America, right? You had a butcher, you had a mailman, you had a hairdresser, and you had a banker. And, in some ways we moved away from that, I would say almost as a byproduct of consolidation. But there's a lot of times when that personal relationship is critical. And, like I said, I think it's a good reminder for folks that, especially small business owners and operators, where, there's a lot that can change, good news and bad news, right? And you'd like to know that you've got a banker you can call to get things done, or somebody that can work with you. And I think that's one thing the community banks have always prided themselves in is, not taking an adversarial approach with our customers, right? We all live and work in the same communities, and we're all we're all in it together. And what that means is we want to collectively be successful. And it's important that the businesses thrive and that the banks work with them to help them thrive. And so it'll be interesting to see whether this is a small change. I think it's certainly going to be a change in how people think about their banking relationships. And I don't know if that's going to translate into a small increase in people using community banks or a large one. But, I think the value proposition is real. And unfortunately, sometimes it takes moments like this for us to realize exactly how and why that relationship matters. And, I think it'll be good for us as an industry. And quite honestly, I think the more folks that end up dealing directly with community bankers, it's going to be better for small businesses as well.
I agree. And I've long been an advocate of the small community bank because you tend to do things that a large bank's not going to do. What I mean by that is when somebody starts a business or has a business in kind of the early stages, and you go into a banker who's been through this before and knows other entities that have done it, they can actually give you business advice, not just lending advice. They're going to tell you why you need to structure it this way and how to actually help your business in order to pay the loan back, right? I mean, it's more than just handing somebody the money is what I've noticed. It's actually more about being a strategic partner in the growth of the entity itself. I mean, what are your thoughts about that? That's what I've noticed, at least.
Yeah, I listen, I agree with you 100%. I mean, at the end of the day, a conversation where you sit down with a business owner and you say, okay, what are the loans you have? Okay, we'll give you those same loans, and you move on. That's not particularly helpful. Where, we like to start our conversations with, what are you trying to accomplish? What are your needs? How do we make sure you get there? And, I think the reality is those are conversations you're going to have with, senior people at local community banks that you may not be able to have with, a national bank that just makes it much harder to have access to the decision makers. And, listen, having people local makes a big difference, right? When you're sitting in a boardroom in Hamilton, New Jersey, trying to decide how to finance businesses in Mercer County, I think it's very different than if you're sitting in a boardroom or on a teleconference in, Charlotte or San Francisco or what have you. So, I just think we're all more invested in the outcome, and I think we've got the experience locally to help guide people in the right direction.
So what do you think, now that you've been talking to a lot of local business owners, I guess 600 of these you've done so far, what is some feedback about what their thoughts are just as a business owner, and how long that we might be in this kind of this status, and how long it's going to take to move back to what we would call, I guess, a normal or a new normal, or whatever conversation you want to, how you want to frame it. What are you hearing from the business owners about what's going to happen next?
Yeah, great question. I mean, listen, it's going to be as varied as the general population to some degree. I mean, there's some folks who are convinced the world's coming to an end, and there's some folks who are convinced this is a hoax, and we never should have been shut down. And there's going to be everybody in between. And some of it depends on the industry you're in, right? Obviously, certain industries are getting hit a lot harder than others right now. But I think that everybody. The nice part about a crisis like this is there's not an enemy. There's an external enemy, but not an internal enemy. So I think everybody's working together, banding together to try to find ways to get through it. And I think the majority of folks have, a little bit of that, call it the American optimism, in the sense that we understand it's a problem. We understand it's real, but we also know we've seen problems like this before, and we found ways to get through them. And if we stick together and we stay optimistic, we'll find a way to come out the other side and continue to thrive as a country. And obviously this extends beyond the U.S. But so I think it's all over the place, and every day we learn a little bit more. And if you're anything, Kurt, like me, it's a roller coaster. Day one, I see some good news and I'm super excited, and the next day I'm at the bottom of the coaster wondering how much worse is it going to get. And it feels like we're slowly pulling through this. And I'm hopeful that as restrictions start to get lifted, that we do it smart, we do it prudently, but ultimately we can avoid a big future blip. And if that happens, I'm confident we'll be able to survive and thrive.
Now, I know some of the types of businesses out there, we hear about things like restaurants, and they talk about sports venues, and they talk about a lot of other places where they don't necessarily have an answer yet, but they're like, well, how might this change if we have to stay a certain distance apart from each other, at least for the near term? I mean, are there any things that you're hearing from other entities, or any changes that you're planning on making as a community bank, as far as how you're going to interact with your customers once you are able to open the doors up and have them come on in? Any thoughts about that?
Yeah, I mean, right now we've got 16 of our 18 branches open, primarily open on a drive-up only basis, although we are making ourselves available for folks to come in the lobby if it's necessary, and if they have the right protective equipment, we can see people, quote unquote, face to face. But I don't know if it's going to be a massive overhaul. I think it's going to depend exactly how things play out. I mean, we've got 95% of our back office now working from home. I'm not sure how quickly we're going to need to rush people back into a more crowded office environment. So I think some of that work from home may extend for a little bit. You bring up an interesting point about how we're going to work with our customers, right? I think the short answer is, we're going to have to be realistic about expectations. So in a typical economy or typical year, there's certain metrics we're looking for the business to be able to produce, whether it's, cash flow or leverage. And, I think we realize that, few, if any, of our clients are going to hit those metrics this year. And I think we got to be realistic about what that means, and work with folks to get through this difficult time. But I think social distancing is going to be here to stay for at least a while, and obviously the health statistics are going to drive that to some degree. And I'm certainly hopeful that we can keep any future outbreaks under control. But we're trying to find the right balance between the obvious health costs of people getting sick and people dying, and the equally obvious costs of businesses going out of business and people getting laid off and losing their jobs, and the health impacts of being home all the time. I mean, mentally and physically, it's not a great situation either. So, I don't know what the right answer is, but I think, trying to strike that balance is going to be the key going forward. And I think as local bankers, we're prepared to work closely with our communities to do what we need to do to help with that process.
Excellent. Pat, we appreciate you coming on again today. Any final thoughts before we wrap up? You did a great job. We really appreciate it.
No, I would just say thank you, Kurt, for the opportunity to provide some additional information and reiterate your point. If folks have questions, feel free to reach out for us or any of your local banks and see how we can help you get through this challenging time.
All right. Thanks again, Pat. We appreciate it. You're listening to Master Your Finances, and you can listen to this podcast and all the podcasts by going to masteryourfinances.us. Remember, together we can master your finances so you can enjoy financial peace of mind.